Here's a true market update about what's happening in the marketplace. And when we at Seaport are asked the question, how's the market performing? Of course, that is directly correlated to the price range in the town that they are questioning. So it's hard to make a broad sweeping observation about the market, but we can talk about what's happening nationally, what's happening with interest rates. Most people are saying that, hey, values of property are staying high solely because of lack of inventory, and they're right. But we need to dive a little deeper. We need to be able to explain what is happening out there. And here are the nuts and bolts of that. Back in 2021, when rates were at a 2.65% interest rate, if somebody had $120,000 household income, putting 10% down, their purchasing power was right around 600,000, or a payment of 2335. Now today the interest rates have risen to 7.25%, and that's reduced their purchasing power by a lot to $355,000, and their payment would still remain at $2,335. So with a 1% rise in rates is equivalent to an 11% drop in buying power. And historically, what has happened is when interest rates go up, it takes about 6 months to see the changes in the marketplace and the values begin to decline. And the Fed's job of putting on the brakes and slowing down the economy would have worked. And what we're seeing today, you would argue, is, well, hold on, let's look at the towns in southeastern Connecticut. And here's an example of one town as of today where their median household income suggests that the values in that town should be around 368,000, yet properties still are increasing, and they're at 450,000 for the median selling price. So what is happening there? If we've reduced the buying power, how is this taking place? Well, the number of transactions is definitely slowing down. So our pool is smaller, and it's creating a frenzy where people with cash are able to scoop up these properties and keep those values high. But another thing is, why is the inventory low? And the only people willing to sell are those who already have another home or place to reside, and they want to capitalize on the high prices. The other is, if they're the 11 Ds, and a few of those include death, divorce, diamonds, diapers, those would make people move. And this is creating a low inventory situation. Quite frankly, if somebody sells their property for 600,000 and their buying power is only at 300,000, it does not make any sense. So I get the low inventory argument, but it does not explain why the values in some towns are staying the same or increasing. And I want to explain what is happening in regard to that, because the Fed doesn't have control over the way that banks lend their money. And we all know that when things grind to a halt, bad things happen at the banking level. So they need to keep the fluidity going. They need to keep things moving. The only way to do that is to loosen up the back end ratios and the ratios and their lending policies. So lending policies typically say that a consumer, and I'll show you right here, if they're looking at a percentage of their gross monthly income, they're trying to keep their house payments below 35%. So, they could do some work. It starts to get risky when they're between 35 and 50%. And if they're spending over 50%, it's really unhealthy. And we'll explain that in a second. So to dive into the ratio scenario set up by the bank, the front end ratio is simply your principal, interest, taxes, insurance, and is typically 28% of your monthly gross income. The back end ratio is your principal, interest, taxes, and insurance, plus your credit card payments, your car payments, and your student loan debt, which should be no more than 36%, which is still pushing into the caution zone. But typically, it's a healthy place to be if you're a consumer. You still have enough money left over to go out and spend money on daycare, buy your food, go on vacations, put money back into the economy, and things are still rolling. But right now, the banks are finding that because the buying power has been reduced so much by an increased interest rate, they need to do something to get things moving, and then Fed's not helping them out. So what do? At 2.65%, the buying power, like we just said, of the consumer was at about 600,000. Monthly payment was 2335. In today, we're at about 7.25, which brought their buying power down to 355,000. So all those buyers out there in the marketplace just don't have the ability to purchase a property. Yeah, their monthly payment's still at 2335, but they're getting a whole lot less, and the frustration level is through the roof. So what did the banks do? Well, the banks loosened up their front end ratio as high as 43%, which created the back end ratio to go to around 51%, which is definitely in the unhealthy level. But the impact that that had was it increased their buying power to right around 600,000, which is where it was before the interest rates shifted up. And that left them with a monthly mortgage payment, which is 3835, or 51% of their gross monthly income. So this, in essence, yeah, they're able to go out and they're able to purchase properties. And of course, the bank has their best interest at heart, and they wouldn't let them do something that, could pose risk not only for default in the future, right? But it's without a doubt making the consumer house poor, meaning, yeah, you could buy that home, but you may not be able to buy the furniture for that house. You may not be able to, go out on those vacations, spend money on daycare, do all those things that keep the economy moving. And what people don't understand oftentimes, especially first-time home buyers, is that you have to put between 1 to 3% of the home's value back into the property every single year in maintenance, upkeep, and improvements. So there are a lot of question marks there. So what has this caused? This is caused because people do not want to forego the lifestyle that they've created just because they don't have as much money. They are they're using their credit cards more. And that's why we're seeing credit card debt the highest that it has ever been at $1 trillion. So there's some crazy things going on out there. Now, in Connecticut this last week, there was a report that came out that showed the individuals in Connecticut on average have about $9.4 thousand in credit card debt, which is setting us up for not a great landing. And the benefit that we have here at CoStar, my former company, at Seaport, is having access to information to guide our clients in making really good decisions, whether they're buying, selling, or need to hold their property. Whereas many other brokerage companies out there are just hell-bent on getting people to buy and sell. I think good advice here is the important thing, and this is where we at Seaport really earn our pay, per se. And I think our name spreads very quickly because we have access to data that allows people to make a good decision, as opposed to just the emotions that are typically used when people buy or sell real estate.